Putin's advisor, was asked about this a few years ago, and he said, yeah, we produce and consume more than the West, or just as much, yet all the prices are established in Chicago at the COMEX. We want to create an alternative benchmark where we can price commodities on our own terms and reduce all the dependence on the West. Well, they also came out and said that they are going to move forward with launching BRICS Pay, which to me is the big one. They're going to talk about in the summit in September in India. But the goal is to allow members to settle trade directly in local currencies, bypassing SWIFT, reducing dependence on the dollar.
The global financial landscape is undergoing a massive structural shift as Eastern nations accelerate strategic efforts to bypass traditional Western monetary control. Global economic power is rapidly moving toward a multipolar architecture, where benchmark commodity pricing will no longer remain exclusive to Western exchanges. Andy Schectman, a prominent precious metals expert and financial commentator, argues that the official operationalization of BRICS Pay marks a pivotal turning point for international trade. By allowing member nations to settle trade directly in local currencies, these expanding payment mechanisms will effectively bypass SWIFT and systematically weaken global dollar dominance. The formal establishment of alternative grain and precious metals exchanges will soon allow developing nations across the global south to price physical commodities on their own independent terms. Meanwhile, massive underreported gold accumulation by major central banks predicts an intentional devaluation of paper currencies to soft default on sovereign debt burdens. Unprecedented market friction, rising treasury yields, and persistent underreported inflation indicate that the eventual unwinding of global carry trades will happen far more disorderly than mainstream economic institutions anticipate. Now we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
You can see the deliveries of commodities going to the global south and eastward. That's very easy. And you take a look and see what China is doing. They're buying up all of through their Belt Road Initiative and beyond. They just struck a deal, China did, with the largest bank in Africa to do deals in yuan. Yuan is now a settlement currency, not just an exchange, same-day settlement, but a settlement currency in yuan. This is the gateway to pricing commodities and other currencies, having exchanges that price them in other currencies, and deliverability throughout the whole global south. We see that in the expanding vaulting. We've talked about that forever. They will, in a very ambitious way, start to do it through the Belt Road Initiative, just like they're doing BRICS Pay, which is now if you look at what's going on with the BRICS, that's one of their big initiatives, is expanding payment systems that are not compatible with SWIFT. And the big one, probably the biggest one, is BRICS Pay, which is B2B and B2C, consumer to business, business to business. It's now being integrated or discussing integration through the Belt Road, and it is the number one topic on the agenda this year at the new meeting, and along with reducing dependence on Western exchanges and increasing settlement in local currencies, etc. But yeah, I mean, it matters. Why it matters is that it's all about price discovery. And for decades, benchmark prices have been established in primarily Chicago, New York, and London, maybe Paris also. Now you're beginning to see price discovery happen elsewhere. And, everyone wants to know, when does the dollar lose its reserve status? And I think that's the wrong question, because every new payment system or commodity exchange or settlement system that are all interconnected, all of these together are building a parallel financial architecture. And if you don't see that, you're missing the whole story. So recently BRICS came out and they said, yeah, we have officially and formally reaffirmed the plans to operate and operationalize the BRICS Grain Exchange. And this is their goal here, is to create an alternative marketplace and price setting. And they have come out publicly and said it has now moved into the design phase. A conceptual operating model has been completed. A task force has been established, etc. But what this matters for, again, is price discovery. Putin's advisor was asked about this a few years ago, and he said, yeah, we produce and consume more than the West, or just as much, yet all the prices are established in Chicago at the COMEX. And so, we want to create an alternative benchmark where we can price commodities on our own terms and reduce all the dependence on the West. Well, they also came out and said that they are going to move forward with launching BRICS Pay, which to me is the big one. They're going to talk about in the summit in September in India. But the goal is to allow members to settle trade directly in local currencies, bypassing SWIFT, reducing dependence on the dollar, and, building parallel payment systems, settling imbalances in gold through an expansion of all of these multi-jurisdictional vaults. They came out and said not just the grain exchange, but they once again are reaffirming the BRICS Precious Metals Exchange, and that's to create alternative pricing for gold and strategic metals. Well, we see that with what Hong Kong has already done. And strategic metals, who owns the LME? Oh, that's right, it's China. That's the London Metals Exchange. That is the base metals. So you're seeing local currency trends continue to grow. That's not changing. Exchanges are being built. Settlement systems are being built. All of these things are happening. And, I just think what you are watching is a furthering of the financial and strategic integration amongst these members. So, they're not trying to destroy the dollar overnight, but they're building an infrastructure to use it less. And like I said, the largest bank in Africa just signed a deal to settle directly in yuan, but yuan is now deliverable in gold without going to dollars. So that's important because China is already Africa's largest trading partner. They're setting up exchanges and trades and relationships and commodities and trade agreements outside the dollar, outside the SWIFT, and settling imbalances in gold slowly. They don't want a rapid move away from this. That hurts their own balance sheet, but that's not the point. The point is that one trade agreement, one payment system, one currency, settlement at a time, they're laying the tracks for a more multipolar system. This de-dollarization and the de-treasurization is a process, and every new piece of infrastructure makes the process a little harder to reverse, I guess is the way I'd look at it. I said it 100 times, no one else said it. Now I'm seeing people saying, could it be? Sure makes sense to me when Bo Hines is the CEO, when they are now opening up the back end of their system to the Justice Department. We saw that with their freezing of the IRGC wallets. My background just reset there. And now they're buying more gold than anyone in the world, even more so than China, at least. I mean, China was, none of the central banks are being honest about how much gold they're buying. The World Gold Council said their first quarter purchases was 15 times underreported. According to reported numbers, only the Central Bank of Poland has bought more gold than Tether over the last few years. And here it is again, where they are not giving up on this massive accumulation of gold. They bought over 14 tons in the second quarter. Their gold holdings are somewhere in the neighborhood of $20 billion, more than anyone in the world with the exception of central banks, and bought more than anyone in the world with the exception of the Central Bank of Poland over the last 2 years. And I have felt for a long time that they're running proxy for the U.S. government. You buy gold, you devalue the dollar, you'll quietly sell that to the Treasury. And I feel the same way about all the deliveries on COMEX, and the pushback by a lot of people I respect say, well, but it's not leaving. Some is, but a lot of it stays there. Well, if you're Besant, under the guise of the Exchange Stabilization Fund, where this is national security, you don't need to tell anyone what you're doing. You say to Tether, you say to the banks who are bringing it into COMEX to the tune of billions every month, shut your mouth, put this in your account, leave it on COMEX. We'll slowly take possession of it as we need it. We're not worried about rehypothecation. We are the U.S. government. And the same thing is true with Tether. You guys aren't in trouble anymore. You're going to buy gold with all the accumulated interest that isn't transferable on all the treasuries that you accumulate. You're going to devalue the dollar and slowly sell us that gold. You will no longer be in trouble. You're also going to open up the back end of your stablecoin issuance to us so we can program it if need be. We know it's KYC, KYT, and AML, anti-money laundering, know your transaction, know your customer. But they proved through the freezing and blacklisting of the stablecoins of the IRGC in their wallets at the stablecoin level, at the smart contract level, blacklisting them, that they can do this, they being the U.S. government in conjunction with Tether. If you told me Tether was doing this to run proxy for the U.S. government to keep their footprints out of the snow, using the interest accumulated, think the Genius Act coming up where all money movement will be backed by short-term treasuries, there'll be massive interest accumulated, which isn't transferable. You buy gold, push gold up, push the dollar down. It allows us to reindustrialize and sell our product quietly to the world by soft defaulting on the dollar. I've gone over this and over it. You're beginning to see people talk about it now. Maybe I'm not as crazy or stupid as I once thought to say it out loud, what I actually thought could possibly be. But something is weird that a crypto company is buying up massive amounts of gold, more than anyone in the world, but the central bankers who know the playbook. I don't know. Just saying.
A massive transformation in global trade settlements is quietly taking shape as Eastern alliances construct an interconnected parallel financial system. Sovereign states are moving beyond Western paper exchanges by integrating non-SWIFT payment rails directly with strategic commodity hubs across the global south. Central banks and private stablecoin issuers continue accumulating physical gold reserves at unprecedented rates, signaling a coordinated structural effort to quietly absorb physical liquidity while systematically devaluing sovereign fiat currencies. Official government figures consistently understate real inflation metrics through artificial methodological adjustments, disguising a persistent erosion of public purchasing power. Simultaneously, bond market volatility and surging long-term yields reveal a fundamental loss of institutional trust in Federal Reserve policy. The disorderly unwinding of massive offshore Japanese carry trades will trigger severe forced liquidations across global equity and debt markets. These historical shifts predict a permanent reordering of international reserve currency status. Now, let's get back to the interview.
We saw something over the last few days that is very unusual. And that is that you saw first of all, you saw the Fed say we're not going to raise rates, but the market went against them and rates went up. Now, normally the market moves in tandem with the Fed, not against it. And at the same time, we saw the dollar fall. Now, this is only 2 days. 2 days does not a trend make, but we see continued situation where the dollar is falling and yields are going up. It's a bad situation because if you're the world reserve currency and everyone wants your dollar, if you raise rates, you're going to attract more foreign capital into your currency. Dollar is going to go higher. What's happening instead is rates are going higher because of a loss of confidence, and they are selling treasuries in dollars, they being the rest of the world. Not a good situation and very unusual to see the dollar fall and rates to go up. All of these things are beginning to say to me that the very sophisticated bond market is sensing a lack of trust, sensing fiscal and monetary responsibility hitting the corner of the room, and the paintbrushes are getting closer to them. They're painted into a quarter. They can't raise rates. If they do, everything collapses, like we've saw in when the banks fell in 23. And if they continue to ease, if that's what they want to do, remember there were 8 months ago, there were bets of 3 rate decreases. Now we're talking rate increases in September. If they do, what happens to the market? If they don't, and they ease, inflation roars. We're already double what they want it to be. And Besant, what's his name? Warsh was very adamant about the Fed wanting the 2% yield target still. How the hell do you get there? How do you lower rates and ease when inflation is what it is? And so I think all of these problems are pointing to a lack of trust in the bond market. Maybe this is why you saw the private credit CEOs at BlackRock and Blackstone decide to resign. All of these things are converging at once. And the Japanese carry trade has been behind much of the boon in U.S. equities and even treasuries. What happens when that unwinds? That's a big question. And I would argue it happens far more disorderly than it is orderly. And that's why I think these are things that people need to pay very close attention to and in their own way prepare however they see fit. M2, rising money supply is inflation, period. They have us all conditioned to believe it's rising prices, yet they pretend inflation is only 3 to 4%. And the BLS should strip the L out of it and just be BS. They can report only 3 to 4% inflation while the financial system expands the money supply by trillions. That so-called controlled inflation is even easier to report if a lot of that new money flows go not into the basket of goods that the CPI pretends to track, but rather into assets like stocks, real estate, private credit. None of that's reflected in the CPI at all. And so, yeah, it's a big deal because if you are going to see rising bond yields, 5.2% on the 30-year, well, you got to make sure that inflation, the way that you calculate it, is under that number, or why would any sophisticated investor take in your face a real negative return? We know that inflation number is a lie. And so in reality, it is a negative real return. But when you actually make it a nominal negative return, game over. Not a sophisticated investor on the planet that will guarantee a loss in your face, let alone if you just peel back the onion, you see that, well, they are lying to you and inflation is much higher. But if it's actually in your face and it's nominal rather than real, yeah, it's game over. So that's why they have to. And that's why they continue. I think it's called hedonics, where they change. If steak is too expensive, well, you'll eat hamburger or chicken, those kinds of things. And they continue they call it owner's equivalent rent. Instead of saying, what is the housing market doing? It's owner's equivalent rent. What would it be if you rented out your house? How the hell do I know? I mean, it's just stupid, the stuff that they do. And they don't even put into their things like taxation, which is probably the biggest form of inflation, or whatever you want to call it, a cost of living on all of us that are working. So yeah, they have every reason in the world to lie about inflation, and that won't change anytime soon. And Warsh wants to strip out the outliers, make it even a tighter measurement. And if you use his metrics, we're at 2.5% or so. I got a bridge I want to sell you in Brooklyn if indeed you believe inflation is under 3%. They haven't hit that in over 65 straight months. I'm not going to do it anytime soon either.
The foundation of global finance is fracturing as structural contradictions within Western monetary policy come to light. When central banks attempt to freeze interest rates while bond yields simultaneously surge and currency values drop, it signals a deeper systemic crisis of confidence rather than a routine cyclical economic correction. Sovereign debt markets are painted into an inescapable corner where raising rates threatens total commercial banking instability, while aggressive monetary easing will inevitably reignite severe runaway inflation. Official Bureau of Labor Statistics metrics deliberately mask this reality by employing artificial hedonics and owner's equivalent rent calculations, projecting a controlled 3% inflation narrative while trillions in newly created currency inflate tangible asset prices like equities and real estate. Behind closed doors, major financial institutions and central monetary authorities are executing covert proxy operations, quietly acquiring physical gold bullion to hedge against an impending paper currency soft default. This ongoing de-treasurization trend predicts that nations will continue establishing localized trade settlement mechanisms backed by direct physical gold deliverability. As multi-jurisdictional vaulting expands and cross-border payment rails mature, the global reliance on Western debt instruments will diminish permanently, driving yields higher and accelerating structural monetary realignments. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.